Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you. And before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. Welcome everyone. It is time to talk about model testing again. I'm Rob Booker. You know that already. And today's webinar presentation concerns the implementation of the model testing guidelines. Over the course of the last couple of weeks, we've been talking about model testing guidelines, statistics, ratios, behaviors that are important when you test a trading system. What we're talking about here is implementing a trading system confidently and feeling like you know what you're supposed to do. That's the big question, isn't it? What are you supposed to focus on? And we've talked a little bit about setting deliverables. We talked in the trading game about having consequences tied to those deliverables. And we talked a little bit about setting goals that were really meaningful. And in this webinar series, this three-part webinar series, I want to tackle the question of how do you take a goal or a deliverable of implementing or finding a trading system that works for you within a certain time frame and getting ready to trade and knowing that you're going to focus on it. Most traders randomly trade and go back and forth and don't focus on a trading system and are constantly experimenting and trying to find what's going to work for them. And we want to get you off that road and onto a path that actually leads to a specific destination. And that's what webinar part 1 is all about, is setting the table and preparing to implement the model testing guidelines. Part 1 of the webinar is all about simplifying the process of implementing testing guidelines. It can seem daunting at first to approach the goal or deliverable of testing and completing your testing of a trading system to the point where you feel comfortable trading it live, because there's so much work to do. And when you read about testing or hear about testing, you can become dismayed at all the terminology that you need to learn and whether or not you need to test with a computer. It can really be a goal that, instead of inspiring you, can leave you feeling dejected or giving up. And I want to make that process approachable. And in order to do that, we may simplify or oversimplify some of the elements of testing to work for you and to make sure that you can get through the process and still come out with something that is reasonable. Number 1, you should watch the trading game first. Everyone here, I believe, in the webinar today has watched the trading game. You are here live for that webinar series, and you can find that webinar series on YouTube now. And if you have any trouble finding that webinar series, just let me know. You can also find that webinar series on piptoring.com and search for the trading game. Watching the trading game first sets the stage for you to understand that it's all about probabilities and consequences and setting goals that really matter for you as an individual. That's a prerequisite before we can even talk about this. Next, since you've already watched that because you were here live for it, I want to introduce you to the 90-day rule, or a deliverable that is due within 90 days. In other words, I'd like to ask you to complete the analysis necessary to decide on a trading system within 90 days. And you can complete this process in 90 days. It's absolutely and totally possible. It is not outside the scope of what you are able to do. There's no question in my mind that you can complete this process in 90 days, even without a computer running your back testing, even if you have never engaged in this process before. It's absolutely possible that you can complete this process. It won't be easy, but it's totally possible and definitely worth it. You'll need charts. You'll probably want to have 10 years of data on those charts. Forex Tester makes this process very easy. TradeStation charts make this fairly easy. You could probably go back 6 years on TradeStation. That would be enough. MetaTrader makes this process possible. It doesn't necessarily make it easy. Loading data into MetaTrader isn't the easiest process in the world, but you could use MetaTrader. It's not out of the question. There's a lot of talk out there about loading data that is reliable. And if you're using Forex Tester, you're most likely using about the best cleaned up data that we have access to. So Forex Tester is a great place to start. It's got the data that you need over the time frame that you need it for most of the major currency pairs that you would pay attention to. You're going to need spreadsheets. You could use Microsoft Excel and you could use Google Docs. Google Docs is nice because you can access it from anywhere. Microsoft Excel is nice because it allows you to do a significant amount of number crunching that is not possible with less expensive spreadsheets. Later on in Part 2 and Part 3 of the webinar series on implementing the model testing guidelines, we'll talk about loading your testing data into a spreadsheet and having it spit out some formulas that are really important. Many of you are intimidated by having to calculate formulas like Sharpe ratios and Mar ratios and other types of ratios. Well, you're not going to need to do that because we will be able to upload the data into a spreadsheet that's ready to go. You're also going to need time. You can't finish this process in a super short period of time. It's just not possible. You will need to dedicate the time necessary to do this. But if you had, I would say, 2 hours a day at the most, and if you had an hour a day at the least, and you marched forward for 90 days, you'd be in good shape. Some days you might need to spend more time, and some days you can spend less time. You do need time, though. You can't cut that short. You're going to need to put the time in. And I know everyone here listening is listening to this because they're ready to put the time in. So that's not a question at all. You'll also need to focus on one pair to start with and one set of principles or rules. It's not important at the very beginning stage, even if you desire to trade multiple currency pairs. You really only need one pair and one set of rules to start, and then you can branch out from that one pair and one set of principles or rules. Well, as everybody might ask, how do you find a set of rules to test? It's the old needle in the haystack. It's very difficult to find a needle if it is hiding inside of a stack of hay. And some of you have felt in the past that finding a trading system to focus on is like looking for a needle in a haystack. It's very difficult, and the search is endless. Well, that's not necessarily the case, especially for those of you that are members of the Pivoteers. We do have a variety of trading methods that are available to us that start off with some fairly robust principles that you can draw from in order to create a set of rules for testing. Let's talk about different trading methods that you could use as your set of rules. You could use the standard Wallaby. That's just a set of principles that you're already familiar with if you're a pivoteer or if you've read the Wallaby Trade book. The standard Wallaby simply looks for divergence using the Wallaby indicator. Trend continuation, some of you have your own methods of trend continuation trades. For those of you that are pivoteers that are watching this live or on the recording, our friend Ineki has a trend continuation method that she is fond of and has been testing. I don't even know if I'm saying it correctly, but I think we could call it trend continuation. There are a variety of ways to do trend continuation. You could look that up on the web and find a set of rules that you could probably use. Kevin, our friend and pivoteer, has a trend following method that he is seeking to improve, but is already quite robust and has large profit targets and tight stops. Hector has created the Hector Pivot Bias Trade in coordination with Kenrick and especially Michael T. And that's a set of rules or principles that you could draw from, or something else, the Boscillator, support and resistance, or some other trading methodology with which I'm not familiar, so I can't even mention it here. The point is that there are a variety of places to start. How do you know where to start, though? How do you know which one of these that you would choose? You might consider your schedule. Are you able to trade full-time? Are there certain hours of the day that work for you as a trader and certain hours of the day that don't? Do you have a favorite pair? Are you a short-term trader or a long-term trader? Let me take you through some of this analysis. Let's say that I am an individual that has at most 3 hours a day to dedicate to trading. I could pick a short-term trading method and decide that I would look at the very short-term charts like the 1-minute chart. And then I would use that 1-minute chart to plan or take trades. Then I might have to ask myself, well, am I really interested in short-term trading? And if the answer is no, then I'm stuck, right? I've got a schedule that allows me only 3 hours a day, and that might be well suited to short-term trading, but I don't like short-term trading. Can you see here how people get stuck? Let's say that your schedule permits you to trade only in the evenings, and you really like long-term trading. And so you decide that the evenings are well suited for that you could set up your trades, that they would be long-term in nature, meaning chosen from longer-term charts like the 4-hour or the daily chart, and that you would need to free up some time in the evenings to do your analysis and set up your trades. That could work until you realize that some of your best trades fire off in the middle of the morning when you are not available. You're stuck. Once again, even before you start the process of testing, you're stuck. You don't know exactly how to overcome some of the obstacles. And many people complete the enormous amount of testing that they planned to do, but they didn't consider some of these questions, and so they end up understanding that they have a trading system that might work, but it doesn't fit their schedule. One of the biggest problems associated with trading successfully is that you come up with a trading system that works, it fires off 3 or 4 losing trades, and then the very next trade is a winner, but you are unavailable. If you worked for a hedge fund, you would have to adapt your lifestyle to the schedule that your fund put you on. If you are the type of individual that worked on the day shift at that fund, you would need to make yourself available on the day shift, and that would be that. If you didn't like short-term trading, but you were good at it, you would have to overcome your dislike for short-term trading and deal with it, because you would be employed to make money, not to do what you like to do. And that's why a lot of traders who trade for a living in a firm don't necessarily really like their jobs. Although it's something that you would really like to do, there are many individuals, I would say more than 50% of individuals who trade for a living at a firm, don't really care for their job. They don't like the people they work with, they don't like their boss, and they don't like what they do every day. But they still have to go in and do it. Do you see where I'm going with this? That trading for a living has its advantages, but it also has its downsides. That it's not all just fun and games. Sometimes you need to decide on changing your schedule to fit your trading and implementing a kind of trading that perhaps doesn't really fit your personality and that you don't really care for. And there's nothing that anybody can really do for you about that. And that's the problem, right? Somebody might tell you what you want to hear as opposed to telling you the truth about this issue. They might tell you, oh, of course you can trade at any time of the day, and of course you can trade any currency pair you want, and of course you can trade on any chart that you like. Well, you can do all those things, but every single one of those choices carries with it consequences that may not be favorable to you, that you may not really enjoy. I recommend that you focus on finding a set of rules that works, that you go back to the methodology first, and you say, gosh, I do like this type of trading, or I do like this type of trading, or I like this type of trading. And you focus on what it takes. What's the schedule that requires? What's your favorite pair on that? Is it short-term or long-term trading? And then you stop worrying about adapting the trading system to meet your needs, and you adapt yourself to meet the needs of that trading system. If it makes money, you need to adapt yourself to implementing that method. And if you cannot do that, and at the very beginning you are resisting that, then this isn't for you. You wouldn't be a fit at a hedge fund or an investment bank or on the prop trading desk of a major bank, and you're really not going to be a fit for trading for a living at home, and it's no offense. It's just simply the case that perhaps this isn't right for you. Now, you can trade standard Wallaby or trend continuation or Kevin Trend trades or Hector pivot bias with a limited commitment on your schedule. Hector pivot bias trades now only take place on Wednesday evenings and Thursday evenings, and they are relatively mechanical. If you pretty much can be in front of the computer at about 5 o'clock Eastern time twice a week, you can set those trades up. Some people might say, well, that doesn't really suit my personality because it doesn't take enough trades. Okay, well, I'm saying again, you can only have so many things that you care to list as the most important thing. And the most important thing really does need to be making money. I've seen people walk away from profitable trading methods for two crazy reasons. One is they didn't like the way that it dealt with their schedule. And number two, I watched people backtest, implement, and understand that something was profitable and then walk away from it because it was too good to be true and they just couldn't quite believe it, and they enjoyed the process of testing more than they enjoyed the process of implementation. And they would go through multiple trading methods that worked and never really settle on something in the end. All right. More important than all of the questions that I just asked is this: are you an impulsive trader? If you count yourself as an impulsive trader, I have one major recommendation to start this whole process off. I would recommend that you give trading authority to a computer to the greatest extent possible. I would recommend that you implement some type of automated methodology to implement your trading. That may include having an alert fire off and be sent to your phone, and then you take the trade. Or it may include turning on a trading method so that it produces trades for you after the market has met certain conditions. Say, for instance, you're a standard Wallaby trader, and you really like waiting for the market to overextend itself, miss a bunch of pivots, and become very overextended. And then you want to turn on the Wallaby on a certain time frame chart on a certain currency pair. You could then turn the robot on if you know you're an impulsive trader so that you don't take too many trades, so that you don't keep your losing trades open too long, and so you get yourself all squared away and you don't find yourself taking a bunch of impulsive trades. Automated trading in this way helps you meet the needs of your trading system and avoid some of the impulsive actions and the consequences of those actions that might occur. If you're not an impulsive trader, then I don't think you need a robot. I don't think you need that at all. But many people, more than 50% of retail FX traders are impulsive individuals, and they can benefit from some type of automation. It's a difficult fact to wrap your head around because maybe you're not very good at automation. Maybe you don't understand how to automate trading systems. Well, that's all part of the 90-day process, right? Is learning to conquer some of the things that you're not very good at. All right, that sets the stage for us. That sets the tone for the conversation. Remember, we're going to pick a trading system to focus on. We're going to choose one currency pair to start with. We could branch out from there later on. We're going to remind ourselves that if we're an impulsive trader, we may be handing over part of the decision-making process or the implementation process to a trading robot. And now we need to take some steps and move forward in the process of implementing the model testing guidelines. Here are some steps that you can take today to get started. Number one, pick a holdout period. Some of you have already done this, and some of you have not. Even before you finalize your choice of trading systems, or simultaneous with your decision to finalize a trading system that you're going to focus on for testing, you can also pick a holdout period. A holdout period represents a wide variety of market conditions, ranging markets, volatile markets, trending markets, back and forth markets, quiet markets, loud markets, markets that included major economic data, markets that didn't include major economic data, markets that included economic surprises like the subprime mortgage crisis or the blowing up of Lehman Brothers, markets that didn't have anything like that at all. A holdout period represents a wide variety of market conditions. Those market conditions are created by volume, volatility, trending, ranging, economic releases. You might choose a holdout period that is rich in economic releases that surprised the market. Non-farm payroll reports that surprised, went outside of expectations on the downside or on the upside. A holdout period is simply designed to give you a good representation of the market. Remember that past performance is not necessarily indicative of future results, but you want to find a holdout period that's going to represent a wide variety of market conditions, because moving out into the future, the market's always going to do something new, and it's going to do something new based on economic surprises, unscheduled economic crises, based on economic releases, based on simple trends that are extending out into the future, based on ranging markets, and so forth. You'll be testing 300 to 500 trades during this holdout period. So you need to pick a holdout period that is long enough or includes enough time to give you 300 to 500 trades. Now, how are you going to know that it's going to produce 300 to 500 trades? Well, for super short-term trading, like 1-minute chart trading, a holdout period might be very short. And for long-term trading, like from the 4-hour charts, you might need a longer period of time in your holdout period. For example, you might choose for Hector pivot bias trading, which trades, in some cases could trade 4 days a week, and in other cases 2 days a week. You might choose a holdout period of 3 or 4 years. Something from 2006 to 2008 or 2009. If you were a super short-term trader from the 1-minute chart, and you took maybe 20 trades a week, you could choose a holdout period from September of 2008 to December of 2008 and combine that with January of 2006 with all the way through March of 2006. If you were a long-term trader, you might simply choose something like 2006 to 2010 because you need a larger section of data. You might actually, in order to get enough trades and to get enough data, you might need to pick something even longer term than that. The longer the time frame chart that you're using, the less likely it is that you're going to get 300 trades. If you take trades from the 4-hour chart and you pick 4 years of data, it's unlikely that you're going to get 300 trades. You could conceivably only get 100 trades. You could conceivably only get 50. But if you get down into the below 100 range, it's possible that you haven't seen enough market conditions or enough trades to draw any conclusions from the data that you're running. That's a tricky question, and I'm oversimplifying. I promised at the beginning that I would be oversimplifying the process, and I definitely am oversimplifying it here. It is possible that you could have 100 trades and that would be enough data to draw some conclusions. It's also possible that you could have 200 trades or 300 trades and you will not have seen enough data. Let me give you an example of what I mean. Let's say you have 75 trades from a 4-hour chart over a holdout period of 7 years. You've seen a variety of market conditions, up and down markets over a wide variety of years, and 75 trades might be all the trades produced during that period of time. And because the market conditions are varied, and because the market conditions are rich and differing, you might actually, with 75 trades, have something that you can work with. Let's say that you have 200 trades chosen from a period of time that extends from September of 08 to October of 08 on the 1-minute chart. You'd be only looking at 1 month. Even though you have 200 trades, you might have only been trading during one type of market condition, and that wouldn't be enough data. I would recommend in that instance that you might need up to 1,000 or 2,000 trades, chosen from a wide variety of months picked for your holdout period. A holdout period does not have to be consecutive years or consecutive months. You could choose 7 different months from 7 different years for a holdout period for a very short-term trading method. I'm not recommending that you do that, but I am recommending that you don't go back too far. You want to stay relatively recent because recent data is most likely going to approximate the volume and volatility and the number of market players that we do have now. Remember, back in 2001, we were probably doing a turnover of $500 billion to $1 trillion in FX volume daily, whereas now we're doing something like $4 trillion. Market players are different, high-frequency trading and computer algorithms are different, and so picking a recent market is a little bit better in my mind than going back 10 plus years and picking data. Some people feel sometimes that by going back 10 years, they're being exhaustively comprehensive in their testing, and I don't necessarily agree with that. That's not necessarily the case. Remember, you need to pick a holdout period that will allow you to test 100 to 500 trades over a wide variety of market conditions. If you're a long-term trader, your holdout period might extend 4 or 5 years. If you're a short-term trader, your holdout period might include sections of years chosen from 3 or 4 different years. Once you choose your holdout period, and you're not going back too far, you want to start the process of building a set of rules that work during the holdout period. The analogy is the holdout period is like a sandbox. Inside of this sandbox, you're going to play around with rules. The holdout period doesn't ask you to be absolutely rigorous. It says play around a bit. Look at different profit targets. Look at different stop losses. Look at different moving averages. Look at different market conditions that would lead to a trade. Play around with it. I'm not saying that every single trade in the holdout period will have different rules. What I'm saying is, during the time that you're playing around in the holdout period, you want to open up your charts, pick a set of rules, a base set of rules. Standard Wallaby divergence on the 5-minute chart. 40 pip profit target, 30 pip stop. And then you start playing around with that. And then you get 2 or 3 months into your testing and 40 or 50 trades, and you realize, I think I could have tested a different profit target. And you go back and you test a different profit target. Or you go back and you require a certain number of candles to be in the Wallaby trade. You ask yourself a bunch of questions. You could find questions that are applicable in the ebook that I wrote called The Backtester's Bible. J.MP Backtest Bible. You can see a whole bunch of questions that exist for backtesters inside of that document. You move around your holdout period and you say, wow, am I using the optimal profit target? Am I using the optimal stop loss? Now tomorrow we're going to talk more about this sandbox, but you get the idea. I just want you to get the general idea of what you're doing. You want to watch out during the holdout period for changing numbers to be absolutely exact, because you don't want to have small changes in stop loss rules or profit target rules that then have giant consequences. You don't want to do that. You don't want to build a trading system that depends on having a 31 pip profit target as opposed to a 32 pip profit target. You probably don't want to have a trading system that depends on a 40 pip as opposed to a 30 pip. You want to have a trading methodology that works in the holdout period that doesn't require you to have absolutely ridiculously specific numbers. Say, for instance, if you change a number slightly, do you break the whole trading system? If that's the case, then something's the matter. If you have one big win in your holdout period that gives you the profit for the entire holdout period, you have a problem. Because if you change the rules only slightly and lost that trade, you wouldn't have any profit. You want to test the holdout period and start to gather some statistics about your method. You want to gather statistics like win-loss percentage, drawdown, the size of your winning trades versus the size of your losing trades, the total number of trades. You know, the standard set of trading rules, like I had a set of trading rules and here's what they produced. I have a general set of trading rules. Standard Wallaby divergence, 5-minute chart, euro dollar, holdout period of September through December of 2008, and then January of 2006 through March of 2006. And here's what I produced. Here are my statistics. Do you need a computer to do this? No, you don't need a computer to do this. You just need time. A computer can help you, but a computer doesn't necessarily make it better. Remember, MetaTrader running backwards in time taking trades can make mistakes. It can. It can have faulty data, and you don't see every trade, and so you could see a final number of statistics, but you could see you could miss the fact that there's a gap in the data where it missed a bunch of trades or it took a giant profit because it had a gap in the data. Do you need a computer to do this? No, you need time. It takes time to build a set of rules that you like and that work. My suggestion today would be decide on a general set of rules that you'd like to follow if you still need to do this process. For some individuals, like our friend Hector, he's got a set of rules that he knows he likes, and he's been through this process already. So this is review for Hector. For some of you, however, you've never done this before, or you've not done it exactly in this way. We have friends that are kind of in the middle ground here. Our friends Tina and Kelly ran through the historical euro-yen on red zone pivotier trades and came up with data based on 17 months of testing. That's a perfect or close to perfect holdout period. They set their rules, they did their testing, and they came away with a profit, and they finished their holdout period. What they would do next is test an out-of-sample period. And tomorrow we'll talk about testing the holdout period and then moving on to the out-of-sample period. For right now, you have one task to complete today. Run through the elements of this presentation. Get your charts, a spreadsheet out. Focus on one pair, one set of principles and rules. Decide on a set of rules. Decide on a schedule, a favorite pair, short-term or long-term. Make sure you admit whether or not you're an impulsive trader and get your mind ready to maybe turn over something to a robot eventually. And take these steps to get you started. Pick your holdout period. Get in your mind, if you're a short-term trader, that you're going to need a holdout period that's going to probably result in 200 to 300 trades. And start to write down the set of rules that you're going to follow during this holdout period. And that's all you need to do today. You don't even need to do any of the testing today. You can jump in the sandbox and start playing around with the charts and seeing how those rules interact. But don't just run through the charts mechanically. Play around a bit. See if the rules that you have are going to work for you. And tomorrow we'll talk about getting more specific inside the sandbox.